And away we go. Hey, what's going on? Now, I'm going to tell you, somebody watching, you better say if the audio is not right coming out of one speaker. There was a setting that was checked and people were getting audio out of only one side of their speakers. That's no bueno for this channel. That's not how we roll here on the Dapper Dividends YouTube channel, which, by the way, everybody, it is a Monday night, but I have very, very special news. The Dapper Dividends YouTube channel, which you're watching right here, right now, was voted the #1 dividend investing channel by 3 out of 4 people that live in my house. Let's go get it. It's a Monday night. We've got the SCHD rebalancing. Our friend of the channel, SCHD Stan, may be joining us. We don't know. He's packing. I'm keeping an eye on my little green room here to see if he pops in. He's packing for a trip to Guyana, I guess, for 2 weeks. He's going, what I understand, with his dad and one of his siblings, I think his brother. He hasn't been there in many, many years, since he was a little itty bitty baby churn. Yeah, thank you for all of you that are watching on the replay, and those of you that came in from Mr. Kevin B from his live stream. So nice to dovetail along with him. So hey, here we go. We got SCHD going on, and I already see Darth. What's up, man? You got VOO in there. And sometimes, you know, it's going to be hard to argue with on a total return basis. We'll talk about that. We're going to go through real quick all of the additions. And I'm going to start this whole little shindig and is it who? Mr. Peanut. No, it's, I don't know. It's a cat. Cat in a top hat. Top hat cat. Oh, and by the way, Slancha, to all of those of you that are still recovering and recuperating from the St. Patrick's Day weekend. Hopefully you're not feeling green. If you are, maybe you need to do something a little bit different, because what do they say? If you want something different, you have to do something different. So if you're not doing something different, chances are you're not going to get anything different. What's up, Drush? Yeah, that is a classy cat. Okay, so here we go. Away we go by sharing. Share my entire screen and then pop on over to this right here. Well, actually, here, let me do this first. So I think this is kind of funny. Hold on, everybody. There we go. Sorry about the streamception there. So this is Seeking Alpha. If you don't have a Seeking Alpha subscription, you want to read these articles, try it free for 7 days. There's a link. You can save yourself a few bucks. I will say there is a spring sale coming up. They have forewarned me from the powers that be over there in the Eye of Sauron at Seeking Alpha headquarters. So if I can get this set up here. Anyway, so here we go, SCHD. And there was 4 different write-ups for today. So starting here with Mr. Nicholas Brado. And I thought this was kind of funny. He gave it a buy at 6:17 a.m. The one I liked was by Sunday Investor, so shout out. He gives it a hold. And then we had a sell from Psychoanalyst, and then one more buy from Cash Builder Opportunity. So kind of all over the map. We got 2 buys, a hold, and a sell. And again, this is a really nice Seeking Alpha. I like it. So, oh, by the way, also there is a link below. I just last night went through and downloaded from Schwab's own page. This is a spreadsheet where you can get on the link also that I shared with all you people, from the left column as it was as last night before the rebalancing, and then on the right column, and then according to which made it easy, our friend over here, the Sunday Investor, what they added and deleted. So either way, 23 stocks went in. They swapped out. This is SCHD tracks the U.S. Dividend Equity ETF. There's a bunch of rules and criteria that tells what can and what can't be in. So once a year, every March, right around March 18th, they rebalance this whole thing. They rebalance the index, and then Schwab just tracks the index. So it's not people at Schwab saying what's going into it. But the thing I want to say about SCHD is, if you don't know, now I know it was the new hotness not too long ago, but it's the stalwart dividend ETF. It is what it's more of the safe play dividend ETF, more for income investors, I think, that don't want to worry about a lot of volatility, as we'll see here. This is, we'll just go through this article. I can see on my phone there. If you really wanted to, you could pause the video if you wanted to read this. So I'll just briefly kind of stop at some pages, but here's the 23 that went in. We had Bristol Myers Squibb was now the number one. That was the big one that went in. Hershey's, Cincinnati Financial, Skyworks, CF Industries, Dick's Sporting Goods. They're going to be the lowest yielding position now. Tapestry Inc., which I honestly, some of these I'm not familiar with. East West Bank Corp, APA Corp, HF Sinclair, ticker DINO. Shout out if you've been on the roads of America and you've seen that green dinosaur. That's Sinclair. So HF Sinclair, CH Robinson, they do the transportation. I think they came up on Kevin's last live stream I was on with him. Vail Resorts, ticker MTN. Want your skiing? There you go. Nexstar Media, which is one that we're in. And it's an interesting thing. We can talk about it later. Remind me, ask me about my Nexstar Media position if I forget to talk about it later. But we have some upgrades to the experience of our life we're going to be investing in, I guess. So we may be reducing our position in that one and another one that's to be named. Anyway, so Columbia Banking System, ticker COLB, Insperity, Lakeland. So a lot of these I'm not that familiar with, but they meet the criteria. They fit the screen. Amerisafe, you can see on the line screen there. Heartland Financial, German American Bank Corp. Never heard of them. Preferred Bank and First Bank shares. And then they have to maintain that 100 shares. So they deleted 23 of them. The biggest one, Broadcom. Why? Because their stock price, driven by the AI hype, and probably rightfully deserved, has just gone up, up, and up. And as you know, or maybe you don't know, when a stock goes up, the dividend yield comes down naturally. So that yield got too low to still fit into SCHD's criteria. So we also lost Merck, ADP, Blackstone Group, Illinois Tool Works, 3M, Allstate Corporation. 3M, that's that one I can see. Williams-Sonoma, again, they went up. They've share price just been going nutty, gone to the moon. So you kind of hate to see some of these go, but then you think after they've ran up that much, what does the growth vector look like? Is there a lot of growth left ahead for them? And continue on, just buzz through these. Northern Trust, Tyson Foods, NRG Energy, these are all gone from SCHD. Kellogg, International Paper, First American Financial, Paramount Global, Advance Auto Parts, which we got out of that one luckily in the nick of time. Lazard, Federal Agricultural Mortgage, I think that's Farmer Mac, right? Somebody correct me if I'm wrong. Stewart Information Services, Sturm Ruger, the gun company, Ennis and Hanme Financial. And yeah, so Sunday Investor, really nice job with this. If anybody knows him, tell him I said this is wonderful. I don't know if this does click. So he did a really nice little chart about the top 3 holdings in each sector. And then he has a little snapshot here. I mean, we're not going to go through them all because I can't see what you guys are saying and I want to talk to you. But yeah, he has a really nice table and his 6 takeaways. Maybe we'll just really quickly here. Their beta, which you remember, beta is the volatility measure of the market or a stock or anything that's trading on the market. So when you see this 0.91, it means when the stock market goes up $1, SCHD is only going to go up 91 cents. But when the market drops $1, it's going to drop 91 cents. So it's a little bit safer in that regard than the overall S&P 500 or so. And, this is an interesting thing he pointed out that I liked is that the index, the dividend yield increased from 3.62% to 3.93%. But remember, there's no free lunch, so you do have to pay Schwab a 0.06% expense ratio, which is really, really low. So the current SCHD dividend yield is going to sit at 3.87%, so almost 4%, driven mostly by the likes of Texas Instruments, United Parcel Service, UPS, and Pfizer. So there's that. Again, moving quickly through these. He just goes on to say pretty much what some of the metrics they use to get that composite ranking, that it's the return on equity went up, but there are other things that went down, like their earnings per share growth rate. So that's almost saying that it's going to be harder for SCHD to grow, is kind of the final point that he's going to make over these couple notes here. And then lastly, if you are like a strict dividend growth investor, that it would probably be better off for you to look at VYM, which is from Vanguard, or the Fidelity ticker VFDVV and VV. And if you want to go back later, we can we can chart those. Let me just do that real quick. And he basically gives it a hold on the screen there and says that he doesn't expect much growth out of it, and maybe not as much dividend growth as we saw in the past. So really quick before I jump back to all you wonderful people watching, I just want to see the comparison between those. Geez, I almost closed everything. That would have been a nightmare. Let me see. So on Seeking Alpha, here you go. We'll see. You can watch how we do this. Sorry about that. So we'll go to charting. We'll select symbols. We'll leave that in there. We'll do VYM, the Vanguard High Dividend Yield ETF, and FDVV, the Fidelity High Dividend ETF. And we will compare the 4 of those. But I want to see the total return basis. So we're not going to do just price return. And we're going to do total return basis update. So over the past year, the winner has been the S&P 500. So there you go. For those of you there you go, Darth, if you're still watching, shout out to Darth. Apparently he's psychic. He knew the answer to this. But yeah, over the last 1 year, FDVV has just been below the S&P 500. And last was SCHD. Couple more time frames here. Over 3 years, FDVV is coming out on top. That's interesting. And over 5 years, some of these, they're all at least 5 years old. So S&P 500, followed by SCHD, and then FDVV. Interesting that VYM is lagging behind. And then, so FDVV hasn't been around for 10 years, but the other 3 here have. And the best performing one, look at that, SCHD. Takes the cake over the past 10 years, but you always have to look at where we're at and where we're going, and not where we came from. That can, be good, but if it's up to Sunday Investor, if he has his druthers, he thinks that the growth might not be there, and we would probably be better off as dividend growth investors because when you have a VYM or an FDVV, SCHD, because of the sandbox that it plays in, it's going to look for it. Put it this way, it's not going to include the lower starting yield, high dividend growth stocks like Microsoft, Costco, Visa, MasterCard, Eli Lilly, businesses like that have just had such tremendous growth. So that's always something to consider with something like SCHD. So those are what was in. I really want to know your guys' thoughts. What did you think about it as we come back on? And Kevin, what's up, man? Sorry, I'm running around like a chicken with my head cut off, trying to get you get on your thing. So yeah, you're not going to see a lot of that dividend growth potentially like we did in the past. So I want to know about, what would you do? Would you consider a VYM? I know Lanny, right? Lanny from the Dividend Diplomats. I think that's his jam, right? He goes with the VYM. Yeah. Oh, here we go. All right. Hold on, Craig. We're joined by a. Don't muck this up.
Hello.
I think I got you.
Can you hear me now?
Can
you hear me now? I hear you.
I hear you. Yeah.
I hear you.
I hear you.
I hear the echo of me.
This is wonderful. The beauty of, we'll drink to that, the beauty of live.
What's up?
All right, Craig, can you hear? Is it good now? Are we good to go? What's
I'm
going
good the
on
whole
here?
time. I don't know if you can hear and see me, but I see you. I hear you. You look great, doing great, but you can't hear me.
Yeah, I actually know it. I know what happened, buddy. I know what happened. I got you connected to my phone here. That's exactly what happened. So for all of you watching, hey, this is the kind of nutty technical difficulties we got going on here. So
I can.
now
I
we
hear that
did
on
it.
YouTube. You got me.
We
All right.
did it. I got you in my ear in live time. It was freaking me out connected to my phone. Anyway, so the man, the myth, the legend, Craig, SCHD Stan. We're good
What's
to
up?
go now. So what's your take on this? I don't know how much of the spiel you heard there, but what do you have to say about this? You take the floor.
Yeah, I only caught a little bit of what you're talking about. So, but I feel that a lot of questions on X today, Twitter. So, a lot of people like, what is happening? Why is Broadcom got? There's mostly like, why cut Broadcom? There's a lot of that. And my answer is always just trust the process. Like the reason you invest in something like SEHD is because it's not based on your opinions and the trends and your feelings and your sentiments, anyone's sentiments. It's cold hard facts. I say it all the time. It uses the fundamentals. It screens for certain fundamentals, and if those are there, they stay in, and if they're not, they're out. And we can invest in individual stocks that we really like, and if something gets removed that you want it in there, you can always invest in that yourself. So SCHD does a great job of doing what it's intended to do. It grows very well with the market. It's not going to go as high when things are flying, but it's also not going to go as low when things get bad. And it's going to generate a nice, decent income for you. Not too high, but definitely not low. And that income is going to grow faster than inflation over time. And sometimes it's going to grow a lot. Sometimes it's going to grow slowly like it did last year. But I think over a long periods of time, it's going to do really well with the growth, capital growth, and with the dividend growth. So you can't get too worked up over year to year moves because it's a look at it in 10 years kind of ETF. So I know we like to dig into it, and I like to dig into it too, but you just can't be too concerned about these day-to-day moves or year-to-year moves because you don't know. Like, what if, I'm not saying it's going to happen, but what if this is the top for a stock like Broadcom that's run up a lot? You just don't know. You don't know whether a move is good or bad until later. So it could be awful. It could be terrible. I'm not saying it's good. We
Yeah,
don't know. There's
it's
an old story like a Chinese fable, and it's like you never know if it's good or bad luck if something bad happens because that turns into something else. Like a father had his son fall off his horse and he broke his leg, and somebody came and said, "Oh, that's such bad luck that your son broke his leg. Now he can't help you around the farm." And he goes,
yeah.
"Well, we don't know." The next day, the soldiers came and said, "There's a war started, and we need to recruit every young man." He couldn't go because he had a broken leg. He didn't have to go to war and die. Like you just don't know how things are going to turn out, even when something looks bad.
Well,
So
that's the
yeah,
great thing about this movie. Nobody's seen it before, so we don't know how it ends. What do
exactly.
you think about what is your take on diversifying across dividend growth ETFs? So, Sunday Investor on Seeking Alpha had pointed out that he doesn't think that the SCHD dividend or its capital, stock price appreciation is going to be like it was in the past, and it's just something that for somebody, dividend growth, pure dividend growth investors, that they might want to consider a VYM because you're going to get exposure to a lot of those stocks that have the low starting yield and the high dividend growth, like a Microsoft, Visa, Costco, MasterCard, things like that. So, do you think then that SCHD is better for maybe older people that are looking to live off of their income? They have more of a fixed income, or do you think like younger people might benefit more from a VYM?
Yeah, well, see, the thing about that is I wouldn't say I don't know. That's the one he pointed out. VYM would be the alternative. I
Yeah,
don't personally.
VYM
I
and
don't think.
VYM and the Fidelity high dividend growth FDVV.
Yeah, that one I've just learned about recently, and it looks pretty good. But if you were younger and looking for more growth, I would go more towards, my opinion, to something like DGROW or VIG, not VYM. Like VYM for me, I love it, but it seems very stable, slower growth. Like it's like your J&J. Like it's really heavy in J&J. It's got some stocks that have done really well in it, like JPM, but it's more slow and steady. Like I would
So
say
here,
that's for older. Like I think SCHD grows a lot faster.
so here we have DGRO,
Yeah,
0.08% expense ratio, just slightly higher than SCHD. And I wanted to see their top holdings, which is
yeah,
going
you're
to
getting in there. You're getting stuff like Microsoft. You're getting Apple.
there you
You're
go.
getting
Yeah,
still got
so
Broadcom, JP
you can
Morgan.
you can
Yeah,
see that, right? Yeah, Microsoft. There you go, broad. So you're going to have a lot of higher tech exposure. You got your
yeah,
J&J in there and some of your energy stocks too, Home Depot. 424 holdings too.
yeah. It's very
And
diversified. Yeah.
there's so
And VIG
18%
is very
tech.
similar, but with like a much lower dividend, like a 1 point something, but it moves almost like the S&P with
And
kind
that
of
was
like
VIG. Let's
a little bit slightly safer because you're dealing only with like companies that pay a dividend. So it's almost like the S&P
Yep.
with
There you go,
dividend companies,
VIG.
but they really look at companies that have room to grow their dividend. Like part of their methodology is looking at the expense. Sorry, not the expense ratio. The room they have payout ratio. It has to be below a certain amount so that there's room to grow it. And they actually even cut out the highest paying dividend payers. They cut them out. So it always have kind of like a low dividend but a nice high growth. So it's see the same sort of holdings.
Same. Yeah, it's a lot of overlap between a lot
Yeah,
of these with their top 10 hold. I mean, very, very similar
yeah. Like
overlap.
and so I
318
recommend these
holdings.
two for younger people, not VYM. Like VYM is very stodgy. Like
Yeah.
it's it's for saving your money. It's a good like
Be careful who
capital
you ask here,
preservation.
because psychoanalyst, he had a sell rating on SCHD too, and he's got one on. So that's a tough analyst to prove here on good old Seeking Alpha. So
Yeah, I mean everyone's got different opinions,
point oh,
right? Like
yeah,
there's,
I like that, man. Nice call. VIG also. So yeah, you
and
guys.
then the other one is DGRW. Yeah,
I think
that one's a nice one for growth too. This past year, their dividend growth actually went down, but it's still a nice for capital appreciation,
yeah.
and it pays out monthly.
And it's one of those things that when you're investing in ETFs, like you really have to understand the
Yeah,
underlying and the criteria that they use to put things into the ETFs, because they're just not. You just can't go blindly buy any ETF, except maybe, right? Wouldn't you think maybe VTI or like the whole
yeah,
stock market ETF
yeah.
like
If
that?
you're going S&P 500 or VTI,
Yeah,
you don't really
yeah.
need to worry too much about it.
But when you want to start getting cutesy and going out into some of these other ETFs, yeah, because the ETF is only going to be as strong as its underlying, what is inside of it,
Yeah,
and yeah. So I want to see what you guys are saying. So those of you in the chat, those of you watching, let us know. I mean, share. This is our community. I mean, we're just two guys here. Craig's gonna be going to Guyana, right?
Guyana. Yeah, yeah.
Nice.
The
That's
homeland. Back to the homeland. That's where my family's from. One side of the family's from there. And I haven't been since I was a baby, so I'm really looking forward to it.
beautiful, beautiful. So, yeah, look at this. We got INBM 210 says he buys SCHD for them to do all the work and he doesn't have to think about it. Yeah, and he agrees with their methods. That's a perfect explanation. You have to look at their the whole criteria, what they're doing, what they're
Yeah,
using to, right? What they're using to select those stocks, the sandbox that they're going to play in.
yeah,
And it's just such a critical part of investing. Just beyond anything is you have to know what you own. I mean, it's just so very
yeah.
important.
I think
And
this has been, watching people's reactions to certain stocks getting removed. It's to me, it's like a really good learning lesson for people to see that you can't be tied to the stocks that are in there because they're going to change. You
yeah,
got to believe in the methodology and not in the individual stocks because I'll tell you, like you think 1 year's a change, like how about 10 years down the road? It's going to be completely different, but that's not a bad thing because how many companies might not even be around in 10 years, but you don't have to worry about that because it's going to keep using this methodology that looks at cash flow to debt, that looks at return on equity, that looks at dividend growth and looks at dividend yield. And it's going to keep determining the top 100 based on those principles. It's not based on what we think is hot right now, right? It's based on those principles, and they're not always going to coincide, right?
Yeah.
But one, I'm sure you've talked about it. Like one of the reasons why some of these companies are out is because they've run up too far too fast, and the yield is too low now. So it's actually a signal of getting overstretched. It's not always correct, because something can run up for a long time. It could keep going and going for years, but it is a sign that things have gone too far when you've stretched your yield and lowered it down so low. I don't know if people know this, but several years ago, Microsoft was in SCHD, and but SCHD has performed amazingly since dropping Microsoft. At the time, if it's very similar to this, it ran up too much. So, and then look how far Microsoft's gone. You could say, oh, what a terrible move. Yeah, maybe, but at the same time, SCHD has been just fine, and it does what it does. Personally, one of the reasons why I invest in SCHD is because it's very different from everything else. So many other ETFs have Microsoft, Apple, Broadcom. They're in there. They're in there already. So investing in SCHD gives you an automatic diversification from all these other ETFs, and probably a lot from many of the single stocks you'd pick as well. So it's a nice floor. It's like a stabilizer to your portfolio. You'll like it when times get bad. When things are flying and tech is all the fancy, and fun, you're kind of like, why am I holding this? But when things go wrong, like they did in 22, you'd be happy you have some SCHD to stabilize your portfolio.
And I like how you said some, because I think some people can get carried away and they're just going to want to put everything. I'm going to put it all into SCHD. And it's like, no, don't do that.
Yeah.
It's not a whole portfolio type of thing. It's like you said, it's just some.
Yeah.
So what, I don't know if you want to share that, but what percentage of SCHD is your?
Yeah. Well, what I'll tell you more importantly is, like, I would like it to be like maybe 33% of my portfolio, 25 to 33.
Yeah.
And it's not that. It's actually lower than that. It's a good chunk, but we've talked about it before. Like, I have too many stocks, and I'm trying to sell them and move more to ETFs, so I don't have to worry as much if these ups and downs, and if companies go out of business, or just something changes and they don't have the moat they used to have. You invest in an ETF, a good ETF with a good methodology, a trusted one, and they're going to take care of that for you. The companies that don't do well will just fall off, and they'll always hold companies that are going to eventually bring the stock up, so the ETF up.
You think of it as dividends plus stability, I think is a good way to look at it. Just again, those stalwarts, and it's not going to be, as we saw with the lower beta. I mean, it's just not going to be as volatile as the rest of the market.
Honestly, I look at it as I don't have a lot of bonds in my portfolio, and I look at it's not the same. It has a lot more risk than a bond, but it's similar to a bond that it's going to stabilize the portfolio when things go bad. But it also been able to, in the past, keep up with the S&P 500. And that's not always going to happen, but it gives you the potential of great capital growth. And say what if SCHD doesn't get 13% CAGR every year, but if it gets 7 or 8, giving you a nice, safe yield that's always growing, that's a good chunk of like 20%, 25% of your portfolio. That can be something like a bond for you, especially for young people where you don't really want to invest in bonds. Do something like this that can still really grow. And that yield is always going to grow. Whereas a bond, you're stuck with what you get. Your yield is what you get.
Yeah, and I did see that the yield, he pointed out that the yield is now, it went up from, I think, 3.62% to 3.93, but with the 0.06% expense ratio, we're down to 3.87. But still, that's got your yield on cost. Do you know your yield on cost with SCHD? Because you've invested.
Yeah, I could look it up.
It's got to be right.
It was already higher. So, and it won't show up now. I won't be able to know what the new one won't show up until they start paying out the new payments. I'll look it up. But what I wanted to say too is that with another way that SCHD grows the dividend over the years is by flipping out lower yield companies and adding in higher yield. It's not just the growth from the individual companies. Like, you look at Broadcom and you're like, oh wow, it had 14% growth, like dividend growth, like you lost that. Yes, it's true. But you're also adding, like you said, you're taking out some lower yields and adding in some higher yields. So automatically, boom, the dividend growth just jumps for this year, like just from adding in the stocks. And this doesn't even count how they're going to grow their dividends this year.
Look at that. We've got Nicholas on here. He's one of the people that wrote, one of the analysts
Oh,
that
I
wrote an
talked to him on
article.
Twitter
And
today.
yeah,
Yeah.
yeah, Nicholas, I didn't read your article yet. I read Sunday Investors, but yeah, I love that, man. You're spot on. You're investing in the methodology, not the individual holdings, because right, the methodology is what's going to pick the
Yeah.
individual
They're gonna
holdings.
change.
So, like that is a fantastic point, and just bullet point that one. Highlight it. You have to understand the criteria because, like, put it that think of if somebody was just buying SCHD because it held Broadcom like a month
Right.
ago and they went heavy into SCHD because they're like Broadcom's the top holding and then all of a sudden rebalancing happens and all of a sudden yeah, so that's fantastic. It's just better to look at the methodology and not
Yep.
the individual holdings.
My
And by
yield
the
on
way,
cost is
somebody
3.8.
that has two thumbs sold Snap-on because SCHD held it a while ago. So yeah,
Wait. Wow,
where are
wait.
you pointing? Me?
You. Yeah, this
Point
guy.
to me. Yeah, this guy right here. I did. Anyway, so your what's your yield on cost? Did you find it?
Yeah, 3.8 right now.
Okay.
So that'll jump over 4, I bet, once it's after the year.
Yeah, yeah, and you've only been holding it since hell, it's 2018, right? I mean,
Yeah. I did
What-
buy most of my shares, like a good chunk of my shares when like those dips through like 22 and 23, like a lot 23. From October 2022, then like every dip in last year, I was
So-
buying.
do you think that then, because the earnings, I think Sunday Investor pointed out that it's going to be likely a little bit harder for SCHD to grow its dividend because of the holdings that are in it right now. Obviously, that'll change, but
Oh, it's possible. We'll just have to wait and see. Really, we'll have to wait and see. But like when you look at the 5-year growth at 13%, like that's not sustainable, right? But I think if you can stay in the 7-8 range, I'd be more than happy with that. That's beautiful, and I think that's more realistic. So I would like, last year, what was it, 3.5 or something, like, I'd like to see it get up. And I think over the next few years, I think it's not. I think that's on the low end. Like maybe we'll get maybe it'll be around that for a few years, but I think eventually we get back into the 7s and 8s. Who knows? But
yeah. And then a good information page again, everybody watching. There's a link I put to the Schwab asset management page for SCHD, where it'll give you everything you need to know about it. You can download the fact sheet, the prospectus, but it's kind of cool. Every day you can check in and see if the net asset values are above or below. If you look at it that way, if you want to get a little bit of see if there's a premium or a little bit of a discount either way. But yeah, the top holdings, it'll always be there. So even if you don't have, which I think even on Seeking Alpha, if you don't have a subscription, I think you can still view the summary page, but you can always click view all holdings and it'll just pop up a window for you, and you can always see where yeah, and this will change, right? Because where it says percent of assets, 4.69, they're
They
not
update
supposed
that
to be
every
over
morning.
4. Yeah,
Yeah,
so they're
well,
not supposed to
they'll
be
only-
over 4.
yeah, so they'll only update, like they only change that like on the rebalancing. So reconstitution and then the quarterly rebalancing. So if something goes over 4, then it'll come down. And then if the stock runs up, it'll go right back up until the next rebalance.
Yeah, and just a lot of the stalwarts that you're getting there again. I mean, at the top there, Ford, okay, hey, it fit the criteria. And again, for better or worse, just to Nicholas's point, that is exactly what you're doing. You're investing in the methodology and not the individual holdings, because those are going to fluctuate. So you're going to have to be okay holding a Ford. And if you don't want to hold a Ford, well, I don't know, then maybe you're stuck. But
Yeah,
and it's kind of like, right, it's just like any ETF you buy, and that's why some people don't like put it the real estate one, VNQ. There's a lot of healthcare REITs, and REITs that we wouldn't really want to hold. So you just got to know if you're buying that, you're also buying all the junk as well as all the good stuff like the Prologis and whatnot. Which, by the way, no, in all of these high dividend growth ETFs, there's no, as far as I'm aware, there's no real estate or utilities, and I think that's mostly because of the tax treatment, I believe.
Yeah, most of them. Yeah, there are some that do it. That SCHD no and Dgrow no. Big no, I don't think so. But there are some that do.
My man here he says what's in and out. Well, you could rewind it to the beginning. I got to it pretty quickly. He's eating at Twin Peaks. So shout out. I think Twin Peaks was going to be IPOing, or the business that owns them. There's a company that owns them. Somehow they were going to be holding them. Yeah. Speaking of Ford, we're in the market for a new car, and I might be having to sell some investments here. So stay tuned for that. And yeah, this is Dresh is right. Dick's Sporting Goods. That's the lowest yielding stock in, or the lowest yielding position, I believe, in SCHD right
It's
now.
had a good run. It's had a real good run since COVID.
I do get Mr. Dress's joke there. We'll keep it above the belt and on the up and up here. I will say, sir, nicely played. If anybody else has any, more or less pretty obvious double entendres like that, I love them, man. Keep them coming. But yeah, Dividend Dude. By the way, nice channel he's got growing over there. Dan, told you I remember Muddy. I just call him Muddy. He's my Muddy buddy. He doesn't want to hold a Ford. Okay, well, Journeyman, what's up, man? Nice to see you over here. He still would have exposure to Broadcom from SMH. What is? Oh, that's the semiconductor.
Yeah, I've got that one too. That's a nice. It's been good, man. that's a nice way to play the semiconductors instead of like, well, is Nvidia overvalued and who's going to be next? Like who's going to go up next? Just bet on the top ones. SMH is nice.
Yeah, I think if I had to do it, because I'm, as our Lord and Savior Warren Buffett would say, that if he can't understand something, he can't reliably project where it's going to be in 5 or 10 years. And if that they have a competitive advantage, their moat, if that's still not going to be here, he's not going to invest in it, and he's going to miss a lot of those opportunities. But hey, he invested in Apple, so you got Warren Buffett. So like Charlie told him, you're either Warren's gone crazy or he's learning, and he would like to think it's the latter. So we need to keep learning as well. And yeah, so Dan says SCHD is great for stability and consistent inflation beating dividend growth through though for sure, just not for him. And that's exactly, I think, what it's going to do. And yeah, I think it got a little out of hand when something catches fire on YouTube. I'm a little guilty too, but everybody does videos on it. I don't even know what the new hotness is now, but
Nvidia.
SOXO. Oh, Nvidia. Yeah, there you go.
I mean, it was an exciting time, right? It was a dividend fund that was beating the S&P for a short time, for a period, and then everyone was like, "It's the best of both worlds." I said it was the best of both. I said the same things, but at the same time, I knew that it's not the end all be all. Like, I invest more in the S&P. I've always had. I contribute every 2 weeks to the S&P. Like more than half of everything I invest in goes into that. And then I try to build like the stability cornerstone with SCHD and then pick a few other stocks. One way I'm looking at it now is I want to build a good chunk of like a growth fund. So that could be like SCHG, it could be QQQM, it could be, something like that really flies up in good times, but will go down big time. In down times, it's going to go down. Have something stability like S&P, that's like a good chunk, and then SCHD as the other chunk. So SCHD stabilizes things, the growth fund picks everything up, and then you got, the market, VU, S&P 500 just, doing what it does. And, it's the all-time winner. It's been great. So, I say if you're younger, put more into the growth side. And if you're older, put more into the dividend side. And you could even change that SCHD to a DGROW or a DGROW and an SCHD or a VYM, SCHD, DGROW, like mix it up, There's lots of different ways to do it, but there's some really great ETFs out there for doing this.
I got a question. Do you drip your SCHD shares?
I
Or your
eventually
dividends,
invest them
not your
back, but
shares, dividends.
I don't drip them. I wait for what I see as a good opportunity, and it always worked out for me until the last one in November, because I literally after the day that got paid out, SCHD hasn't looked back. Like it was at 673 back then in December, and then now we're up to almost 79. So it's been, and I keep thinking back, oh, that 73 doesn't look so bad now. But back then, right, we were in 72, 71, 70, 69 for it felt like the longest time, like right in that range, and then gone.
Yeah,
Feels
and
long gone now, but hey,
it
let's
just
go
you
back.
just and it just goes to show we don't know what's
We don't
going
know.
to happen. Like
Yeah.
nobody knows, and we all have opinions. And I know everybody in the world of social media like wants black and white. This is what's going to happen. And
Yeah.
I mean, a lot of people make a lot of money promising magical gains and returns to a lot of
Yeah.
people. And hey, if something can be sold, I've learned on Wall Street, if something can be sold, people will buy it, and it's just or it's going to be sold. I just done talked myself into a knot.
Yeah,
If
people just have to
something,
remember that the things that have run up big now won't necessarily be the things that run up the next few years or whatever. Like it goes in cycles. There's ups and downs, and find a strategy that works for you and stick with it. So don't jump ship. If you've done a lot of research and you feel good at the time you got into it, stick with it. Like when something changes, that's not substantial, like world changing, stick with what you've done and give it some time to play out before you panic, right?
yeah, I think some of the greatest investors, what they have to say is that what you should do is find something that you can stick with and is going to work for you, and
Yeah.
just stick with that and do that. And
Yeah.
it's tough because we all see other people, wild speculation or getting rich in something, and we see our neighbors getting rich, and then all of a sudden, it's human nature. We want to do that too, and it's easy
Yeah.
to get caught up in speculation and doing something you don't
Yeah. I feel
understand.
fully confident in that in 10 years, SCHD is going to be worth a lot more than it is today, and that dividend is going to be grown a lot higher.
Yeah,
So
and
that's
that's
why I
the
stick
thing
with
is
it.
it's exactly. You stick with it, and that's I think that's one of the best things you can do, and that's why
Mhm.
ETF investing is just. Anyway, Rex, what's up, Rex? It's been a minute, man. I haven't seen you. He drips because he's not smart enough to do anything other than do DCA. It's funny when you do drip, which is dividend reinvestment. It's kind of funny because it automatically forces you to buy less when something is high and buy more when something is low. So, like you said, if you were just had your automatic drip turned on for SCHD, you're going to get more shares, fractional shares or whatever, when it was around 68, 69, $70, way down
Yeah.
there. But now when it's almost 80, you're going to get less of it. So, yeah. Is it good? Is it right? Is it wrong? I don't know. But over time, we know we have to keep investing
It
in those
works
things
out.
that we know are going to go up and to the right. And what do you know anything about? I don't remember SPYD. Is that the dividends from the
Yeah.
S&P
I don't
500?
love it. I don't love it. It pays, I think it's a monthly. It's basically just the SPY,
Let
like the
me look
S&P
at it.
500, and they literally just take out the non-dividend payers and keep the dividend payers. I think there's a lot better options than that. It doesn't. If you look at the performance, it's not great.
Let's look
Um,
at SPYD here. Mr.
yeah.
Craig, 0.07% expense ratio, not terrible.
What's it been? It's doing better lately. Is it doing better lately? Yeah, everything's
Let's
doing
see.
well right now.
Yeah, 1 year up 7%, but that's just the price return, not total return. But I want to see its top 10 holdings.
I
Yeah,
used
look
to
at
own
some of the
some, and
guys.
I remember it just went sideways for
Sell,
years.
hold, sell, hold. Okay.
There's better options. If you're looking for dividends, there's much better options
All
than
right,
SPY.
let's
I
see
mean,
that.
look into it.
There we go.
Um, but I held
Ooh.
it for a while, and it
Oh, that's
went
interesting.
side.
Real estate is the top
There's the one.
holding
I knew there was one
breakdown.
that had real estate. That's it.
Wow. So what do we got? A top 10 Iron Mountain Public Service Enterprise Group, PSEG, Oni, 1OK. I can never say it. Onioke, 1OK.
And I think
IBM, Eversource, Altria, 3M, AbbVie, Hasbro,
they're
Ford.
balanced. I think they just
Yeah.
equal weight. So the equal weight all the dividend paying companies in the SPY in the S&P
Fundamentalist.
500.
Yeah, I can't see it right there. I'm not
So
going to make
like if
everybody
you just
stare at
look at the
these words.
methodology, there's not a lot to the methodology. It's just
Yeah.
cut and dry.
Well, I guess that's why there's so many holds and sells, and on good old SPYD. So yeah, I had never really dug into that one before. So there's our thoughts on that. And look at, I love all these VGT. I don't know if that's Vanguard.
That's
I
a
haven't looked at
Vanguard
that.
technology. It's all technology fund. So doing
Big
great
E's
right now,
dropping.
but won't
Big
always.
E's dropping the mic. He's got SCHD, VOO, and triple
Beautiful.
QM.
That's what I'm talking about. That's what I'm talking about.
30% each. That's pretty solid. Big
Yeah.
E, man. Nicely done. I like
See, and
that.
then
That's
something like
mouse.
that. Look, that's a perfect example. So now, if
Yeah.
you're younger, if you're like under 40, you could skew that more to the QQQM because you have more time to ride the roller coaster. You just got to be ready for that roller coaster and put less into SCHD. Like, balance it out. When you get older, put more into SCHD. And then,
we keep thinking, or at least I keep thinking, how much longer can this tech thing go? We keep thinking the market's overvalued, and we keep hearing about all these metrics from how overvalued the market is, but it's potentially a new dynamic because a lot of these businesses are so capital light that some of the old school metrics don't apply to a lot of these businesses that have this hyper growth. And when you can have billions of dollars of market value added with very little capital to do that, why does it need to stop? I mean, it's kind of like Google back in the day. When people click a button on their mouse and you make money, that's crazy. We never saw that like from the chemical companies in the 1930s or 40s or something.
Right.
It's a different thing, and some of us have trouble, probably myself, wrapping our heads around,
It's why I do like, though, like SCHG, which just focuses on the growth. It doesn't focus on tech in particular, but if tech is leading the way, it'll be at the top. If something else leads the way, it will take its place. So something like SCHG is nice. And QQQ does some of that too because they have a variety of different stocks in there. But something like VGT is betting all on tech, right? So great for now, and it may continue, like Russ is saying, but maybe one day it doesn't. So I like the diversity of saying, I'm going to bet on growth. I don't care who's the leader. I'm going to get it by betting on growth with SCHG. And VUG would do that too. VOOG.
There's so many, and it's funny because then you gotta, when you see that V, I can't think of times it's not. It's Vanguard, and then the FD is Fidelity.
Yeah, and Fidelity you have a growth fund. Like everybody has a growth fund, so look into them, compare the expense ratio, and see if they have anything to their methodology, like what they actually do.
Dude, I love that. I wish I could highlight that. Like Nicholas said, you're not investing in the ETFs individual holdings. You're investing in the methodology. That is just, if there's anything, like one thing to remember from this whole live stream is that thought. You're investing in the methodology of the ETF. So you better damn well find out what the methodology is that you're putting your money into.
And I trust the process. When it comes to SHD, I trust the process. It works in the long run. It works for what it does.
Michael. Michael corrected me. One Oak. Okay.
Nice.
It's like this guy over here from Chicago talking about One Oak. One Oak. Only okay. SCH, which was the international SCHD?
SCHY.
SCHY. Okay, I've been seeing some of the chitter chatter there in the comments, and what do they invest in? Let's take a quick peek at them because
you might not recognize the company, and that's why it's another reason to have a good methodology. If there's a good methodology, it almost doesn't matter. Like for an international fund, you definitely want to look at the methodology because we don't know these companies. You're not going to know all of them anyways. You might recognize a couple.
Let's see. I'll look at the expense ratio, 0.14%. So it's more than double of SCHD. And
still good for an international fund. International funds always charge more.
Sparser analysis. I don't know if they're going to show it. There we go.
Yeah.
So financials is the top, and if any of you are watching from foreign lands, you might know some of these, but I don't know West Farmers. And there you go, Nintendo, Unilever, TD. That's one of my top holdings. Which you can DapperDividends.com. Click on my portfolio there and see what we got holding there. But Rio Tinto. All right, so we know a bunch of these. No Energas. I know Energas cut their dividend. I don't, if any of you listen to the Dividend Talk podcast, one of my favorites, and they were big holders and believers in Energas, but their management, I guess they said, lied to them. So, if you're an Energas, you might want to get out. But What wait, Sky Fairy, what's up? Thanks for coming on back.
Yeah, that's a good
Six
point.
trillion on the sidelines still. There's an upside.
Yeah, and there's the other. I don't know if you've talked about that too. Like a lot of folks are saying, and it makes sense to me that with that money on the sidelines, interest rates go down, that money goes back in the market. A lot of people might come looking for yield, and they're going to, a good chunk of that will go to the companies in SCHD. They don't have to invest in SCHD. That's not what drives the price of SCHD. What drives the price is people investing in the companies in SCHD. So
Yeah.
but they're going to invest in good dividend paying companies, and that's going to rise all boats with the tide, right? So there's a lot of these funds are going to be doing well if this is what happens.
And
We
you
don't
know,
know.
also that's kind of why the Mag 7, why it's like a self-perpetuating cycle. And I think I've actually forgotten the flip side of it is that because so much of every dollar that goes into like the S&P 500 and a VOO goes into those seven, it's almost unfair, and they just keep ballooning and getting bigger and bigger and bigger. But if that money ever comes rushing out, they fall hard because a lot of money comes out of them. So I think a lot of investors, a lot of new people are I'm starting to get that feeling of like, the market can never go down. We're only going to go up from here. And over time, like, at times the market, it always goes haywire. We don't always know exactly when it's going to happen or the reasons, but over the life, if you ever just Google, history of the stock market or something, and you look at a chart, go back to 1900, it's just up and to the right. And there's those little punctuations when it goes down, and those are buying opportunities. But SCH probably does pay twice a year. I'm guessing a lot of international.
I think they just changed that actually. I think they just went to quarterly, which is pretty interesting. A lot of international ETFs pay like twice a year, but I think they just switched to quarterly, unless it was printed wrong on the straight from Schwab. I saw that information. Quarterly.
Straight from the people at Schwab's.
I love those ads. Schwab.
What ads?
You never see their ads on TV? I'm the only one who watches ads.
Are we talking about the 90s or?
No, right now they have ads on it. The guy's like, he's hanging out with somebody that's like a potential client or used to be their client, and they start talking about Schwab. Yeah, Charles Schwab does this and does that. And he's like, what? And he's like, Schwab. And he gets mad. He sees like a air balloon go by with Schwab written on it or something. He's like,
some people's heads are going to explode being like, what's a commercial? My buddy Korean Cardboard, what's up, man? What's popping? What's crack-a-lack? And he thought about adding DGRO and triple QM. What did we look at triple QM? I don't know if we did.
That's it's basically we'll look at it's the QQQ, but it has a lower expense ratio.
Let's pull it up. Let's pull it up real quick because I'm sure there's probably overlap with that. And let me see here what.
And which overlap with that and what?
What was the other tech one we looked at? Tech focused.
OBGT or what did he say? He said
0.15%. Yeah, I think that was it. So let's see what these good old Seeking Alpha analysts give. Yeah, holds. All right, a couple buys. It's all over the place. Sell, buy, because it's so big. It's covered by so many people, but it's probably mostly all 51% tech. It's all tech driven, which is
very tech heavy.
Yeah, so you got the Mag 7 there: Microsoft, Apple, Nvidia, Amazon, Meta, Broadcom. Yeah, Costco. Boy, I missed Costco. I love you. Welcome to Costco.
When things are good, man, QQQ is on fire. But I think what people forget is remember in 22 that it was down like 40%. People forget that.
It's going to fall
that's
hard
why
when you do
don't want to put everything. I mean, if you're young, if you were 20, you could put everything in QQQ or QQQM. And just
what that's from. You know what that's from, right? I love you. Welcome to Costco. You know what? I love you. Welcome to Costco. You know what that's from? Idiocracy. Here. Watch.
Welcome to Costco. I love you. Welcome to Costco. I love you.
Dude, that's one of my favorite movies. Yeah. Everybody shopped at Costco. They went to Costco for the time machine, and it was a little ride or something. That's So what are your plans right now from today? You're an big. How many shares of SCHD do you have now?
1,551 in holding.
Nice. I used to think that was impressive until we did our chat, and then people started dropping in the comments
I
like,
know,
"I have
2,000.
15,000 shares of
Yeah,
SCHD." I'm
exactly.
like, "Oh man, Craig really doesn't have that many."
Yeah, I slowed down. I stopped, man. Slowed down since I haven't bought any since November.
Yeah, so you're Mr. SCHD. What is the what's your plans on your are you waiting for a certain price? What are you doing with that?
As far as like buying more, you mean?
Yeah, just
Yeah, well,
overall.
yeah, I want to see. It feels, I don't know. It's really weird because it feels like something eventually's got to pull back. But then maybe SCHD doesn't pull back because there might be like a rotation more into value and dividend stocks. So it's kind of a weird situation. But what is interesting is usually when the market there's a pullback in SCHD as well, and then it goes up. So I figure I look at things like when there's a good 5, 8%, 10%, 15%, that's when I look to put like more money to work. So if it goes back 5, I put a little. If it goes back 8, I put more. If it goes back 10, then I really go. And 15, it's like as much as I possibly can. Because I've seen over the years that when a good ETF goes down that much, it's coming back. Like that's a lifetime opportunity. There's a moment, that's the time to invest. Like when the S&P goes down 8%, I've seen studies on this. Like that's the time to start buying because that is going to come back, and they only happen every so often. And so don't worry if it's going to keep going to 10 or 15, keep going. If you can start at 8 and keep going, because once it gets to 8 or 10, you don't get those opportunities often.
Yeah, nobody's going to ring a bell at the bottom and say, "Okay,
Exactly.
we're at the bottom. Go ahead and start buying."
And what that means for people that are a little beginner at it too, what I started tracking is I'm talking about off the high. So you look at the 52-week high, and then I actually keep a spreadsheet of this, of what's the prices at 5%, at 8% back, at 10%, and at 15%. And it highlights when it hits those for me, it highlights, and I start thinking about putting more money to work. Although I'm always buying. So like I said before, like every 2 weeks, I'm auto investing into the S&P no matter what. And then otherwise, my other money, then I'm looking for better opportunities in SCHD and some of these ETFs I love, and individual stocks too that I really like.
Yeah, and it's funny. We just taught you, Ryan, we talked about this in the last newsletter. Is that, man, when I get price anchored, and I think we've talked about this, right?
Yeah.
Your price anchoring. It's so damn hard for me to buy above so I use the example, if you buy a stock at whatever $50 and a year later it's at $90, you want to wait for it to get closer to 50 or maybe 60 in that price range. But the damnedest thing is that you have to realize that businesses increase in value. They can also decrease in value, but if the business is increasing in value and it's going to keep increasing in value, it's never going to go back to your price.
Right. I got one for you. Here's a one. It's going to bother you, I bet, because I bet you didn't buy any. But you were looking at EPD and you wanted it to get down to like 25, right?
You got it, 25.
And it got down to like 26. So I was watching it, and it got down to like 26, like just above 26, and never went 25. Because remember we talked about this too. I'm like, I don't want to do that again. When I really want something, if it gets close, I just buy. Like if you're waiting for 25.99 and it gets to 26.12, why? Because now it's up at 52-week high. I mean, it doesn't move a whole lot. But it's been a great steady stock. Like that thing pays 7%. You don't need a whole lot of appreciation. So, who knows what happens? Maybe it goes back there and way lower in a couple months. But
and the other thing is that you have to remember too, is that when a lot of these stocks, to add fuel to that fire, when they're buying back shares, that makes it even harder for it to go back down to that price that you're magically waiting for. And it's
because I know I missed out on more. I bought some and I'm like, okay, if it goes under 26, I'll buy even more. And it never got there. But I was thinking of you. I'm like,
and it's stupid waiting. And, again, I'll end it with saying that, like, again, Buffett and Munger with their See's Candy example, they said in 1972 that what they were offering for it, if they would have wanted 5 million more, they would have walked away and would have done it. And they say that they were young and ignorant. They were dumb back then. And they learned a lesson from buying the power of a brand with cash flow that's just, swimming in cash and going to keep generating cash flow. And they said if they didn't buy that, they may have not bought Coca-Cola in the late 80s and early 90s. So
I would love to see what dividends, like they talk about how they pay a dividend straight to them, how much they make in dividends on. Wow, look at that. 1550. Nice.
Yeah. Yeah, that's great. And perfectly, there you go. So Big E, if I was you, I'd be like, well, I gotta wait till it gets a little cheaper, but we may never see that price again. But hey.
Big E, what's your handle on Twitter? Are you on Twitter? Do I follow you?
Yeah, put it on, drop it in there if you want. And yeah, holy cow, man. That was well, I'm glad you joined us, dude. I love it. So
Oh, I'm glad I could make it. I didn't think I would be able to. So
yes,
yeah.
dude, safe travels, man.
Thank you.
You know, yeah. And as far as me, I'm gonna keep adding a little bit to SCHD. Also, I'm gonna look into a couple more dividend growth ETFs. I do try and pick individual dividend growth stocks to buy, but you know, sometimes it's just we're busy. We're not professionals. Those of you that don't know, Craig and I, we're husbands, we're fathers, we work.
I really don't
jobs.
listen to anything we say.
Yeah, exactly. There you go. This is all just, you know, conjecture
Just
or
ideas.
whatever. But
Just ideas.
yeah. This is our hobby. We're just sharing our thoughts. So take for what
we've made enough mistakes to learn a few things. That's about it. We've made mistakes, and that's why we know a couple things, but we still have a lot to learn, and me more than Russ.
I don't know about that, but we do love sharing it. And again, this is just a community. We're all helping each other. You know, we're all just doing our thing, trying to just be better investors. So yeah, Biggie, sharing is caring. So yeah, dude. Well, safe travels on your trip. And for those of you that don't know, I'm a kid of the 80s. I grew up in the 1980s. You grew up in the 1980s too, Craig.
That's right.
And yeah. So I
I'm
love you guys.
Russ.
I always leave this show with my man, R.I.P. Paul Rubens. Rest in peace. Pee Wee Herman, take us out.